Welcome back to my channel, The Game Plan. This is a finance channel for investors who do their homework with depth and conviction. Today's episode is one I've been wanting to do for a while because this stock is quietly doing everything right while the market still hasn't fully caught up on this. And we are talking about a company that has been in business since 1928. It has survived the Great Depression, the commodity busts that wiped out half of its competitors. But these guys came out with flying colors, and on the other side, that most miners never get a real durable cash flowing asset. So we'll dive into the company, we'll dive into its fundamentals, and I'll share my thesis and my data points and why I think it is at an inflection point and it could double or triple from here and has a lot benefit from the geopolitical uncertainties. It is one of the largest precious metal mining company in the US. It has the largest US silver mine that is fully built. This company also produces gold. It operates entirely out of North America, which matters more than it has ever before, considering the geopolitical uncertainties and how every country is protecting their rare earth metals and other commodities. So, for years, this company had spent a lot of money to build the capex, essentially its mines. Now that phase is over and the mines are fully built. It generates $2 million in free cash flow every single day. Now, this cash is starting to show up in a measurable way, and the market still hasn't caught up on it. The way this company is going to benefit is on two fronts. Gold is rising as confidence in currencies and government weakens. Silver is rising as the electrification of solar panels, AI plays, data centers, power grids come into play. So this company has those two assets which the world needs. And that is where this is at the right setup. So I'll go into more details, but before that, there's just a history about the company. It was started in 1928, survived the Great Depression, the commodity bust cycles, and it also spent in a lot of areas where they shouldn't be spending. But I think all these years it taught them resilience. At this point, currently, all the learnings have taken into account. Their balance sheet is now repaired. Cash is flowing, capex is going down. Macro tailwinds are completely supporting this thesis, and their key cash flow, net income, and earnings per share, meaning the profits, are exploding. So, which is why I feel it's at an inflection point and the right time to capture this opportunity before it gets into eyes of the Wall Street. But two important points. Number one, for gold. Why is gold rising? There is a lack of confidence in the government because they're all running in deficits. There is a constant increase of money supply, which will continue over the last 2 decades. And geopolitical tension is just going to continue. It's not going to end. I think it's just going to become a permanent noise and it's not something temporary, which is where gold will continue to benefit. The world is in changing order. And when there is a lack of trust in the currencies, gold is where everyone runs towards. One of the prime examples is the Russia-Ukraine situation when US froze $300 billion of Russian assets. That is when the world realized that we could be next. And that's when the commodity becomes more stronger because they run to gold and not US dollars. So which is why gold is going to continue to gain importance and continue to rise. The other important piece is silver. It is one of the most industrial metal the world cannot replace. And this fits in well with the entire AI super cycle, like your data centers, the grids that are needing from an electricity perspective, electric vehicles, which is the future, solar panels, again, a major source of energy in many of the countries and states. So the demand is there and the supply isn't. And as that demand will continue to rise, which is already rising, there is going to be a supply constraint. And having something domestically is a major advantage. So having a this company is going to become a strategic asset for the United States with this, because as the demand explodes, where are you going to go to get towards? You cannot just build a mine and start to generate silver or gold. It takes years. It takes a lot of permits, lot of compliance, government regulations. These guys have completed this. They have gone through all the hoops and bounds, all the difficult phases, and now they're in a perfect area to generate cash flow. They're already doing that since the last 1 year. Now, no one can stand up and build a mine. And even if they try to do, the geopolitical environment is such where countries will not allow this to happen very easily, because they all know the importance of these metals at this point, and nobody is going to let that happen. So it's silver is not a substitute. You can use less, you cannot remove it from the cycle. It's just not possible. So now here it is. Ticker symbol CDE, core mining. And why is core mining winning today? Two aspects that we discussed with gold and silver, why they're important strategically for the US, as well as the growth in the areas that the world is betting on. Electric vehicles, solars, AI supercycle, electricity. These are areas where you will need silver. And this is where core mining is in a perfect area. There are two mines that they have. The Rochester mine in Nevada is one of the largest domestic silver operations in the United States. And domestic production, as mentioned, reduces risks, shortens logistics, and removes political uncertainty and sourcing issues that can occur. It only operates in North America, where they have mines that are all permitted. There's no compliance issues. Everything has been approved. Contracts are enforced. And in an industry where jurisdictional risk can erase value overnight. And this is the stability these guys have. Because tomorrow, nobody can come up and say, hey, you can't run a mine anymore. So they are out of those risks. And which is why their stability is very core to the US. And that's why they're in a very strong position. So I think just to add up, like after a century of so many of cycles, builds, mistakes, and rebuilds, they hold the asset that the market needs. It cannot operate without. And we'll dive into more numbers here from a fundamental perspective. They generate $2 million in free cash flow. Their full year 2025 was over 600, close to 600 million. And they have about $1 billion in EBITDA. They have ton of cash in hand. Their expected profits, or essentially earnings per share, are going to go up by 328%. And they're trading at a 18p ratio. This is unheard of. And I think the reason why they're trading so cheap is because there is some aspects of educational risk. But again, I'll go into the executional risk later on, but this is what's happening. Now, the earnings story is very striking, and I feel revenue growth is very explosive. They're running in 3 digits over the last 2 years. So I think there's a lot of room for upside, and we'll see how they continue to operate. But right now, it's a great one. And I feel it's very undervalued from what they have, and the assets they have are very important strategically for the US. Now, again, I see this stock upwards of $40 to $50. There are some folks who have covered this as a $25 price target. But I think the reason this is trading at a discount is because there is gap between the value of the asset, the current stock price, and I think the executional risk, as I mentioned. Rochester must continue to produce the current production capacity. And then I think 34-35 is a very base case, in my opinion. I think in the next 2 years, I see this going upwards of $50. So base is 34 is what I see. Again, this is not financial advice, guys. This is for educational purposes only. Please do your own research and allocate your position and risk according to your own appetite. Now, highlighting over the risks, I want to keep it real. Now, because there are so many good things about the company, there are things that can go wrong. Like number one is execution, like throughput and recovery rates for the Rochester mine should continue to produce the way it is. Any operational issues that these guys hit can get the results going down, and there can be a correction in the stock price. Prices of metals, gold and silver can again swing, go up and down in the long term. Again, long term, I see both the metals going up, but again, there could be some short term pain along the way. And if there's any acquisitions, that can always add delays or issues. So these are some of the risks that I see. But again, the probability of these happening are low because they are already priced in, but you still cannot ignore them. There is a high chance that nothing of this will happen, but you have to be real. And how I am playing this thesis out is fairly simple. I am going to watch their Q1 and Q2 results and see how they're consistently producing what they had estimated and what the analysts have estimated and what they have guided, what the management has guided. But my approach is build in layers, not all in. So I have added one tranche of my investment, and I will add another tranche depending on how the results are by the end of Q2. But my approach is that the thesis of this particular company is macro tailwinds, which is supporting this operational inflection. They are at the perfect juncture where net income is exploding, profits are exploding, and the geographic advantage it carries by operating in the US. All three happening at once with the geopolitical risks of how important these metals are going to be. This is setting up for a great long-term play. At least 2 to 3 years, this can 3x your money. This is very low. And I'll prove one more thing here. Let me show you something which clearly shows how undervalued it is from an intrinsic value perspective. This is the chart of coal mining. This is around what, $18, $18.53. This line represents the earnings per share of where. Now, as you can see, the moment the stock goes under this line, it starts to go back up. It goes down, it goes beyond this. In the long run, always remember earnings per share is what dictates the share price. So the stock price is going to follow the earnings per share. So right now it is actually intrinsically undervalued by 60%, which is why I feel that as the company grows, this is going to be a 3x play in the next 2 years very easily. But again, there are risks to it. It's a commodity play. Cycles can happen that can pull the investment down. But again, this is where you have to do your homework and know about the risks. So that's all on my end. I have shared all my details. If you find value in this, please subscribe. More stock deep dives are coming your way. And as always, I say research the move, know the risk, and execute the game plan. Nothing in this video is financial advice. I will see you on the next one with another amazing company that I have been researching on, and I'll bring it soon to you guys. That is also another 3x play.